Credit cards, home mortgages, and car payments are just a few examples of debt, and they can add up quickly, causing problems if you're spending more money than you're bringing in. Jeff Sheppard with the Family Wealth Group has tips to help you get your finances in order now before it's too late.
Our whole life, what have we been trying to do? We've been trying to get that job. We've been trying to get that promotion, maybe work overtime so that we can have good monthly cash flow, so we can bring as much money into the kitchen table as possible. Of course, as we're working, it seems like we're paying every tax that they can come up with. We're paying local tax, and we're paying state tax, and we're paying federal tax, and there's a lot of talk about tax increases as well, but we're looking for that monthly cash flow. And so understanding how much bring home is coming in while we're working, and that kind of points to contributions to 401ks and retirement accounts, and what is my employer doing? Are they giving me a match? But understanding, number one, exactly how much is coming in every single month is very, very important as we start to build the plan.
What is debt to income ratio, and why is that important?
Very important topic to really get your arms around, whether you're young or old, is understanding how much debt do you have and how much of that debt is the payment going towards. So in other words, you have a debt, you have your home mortgage. What is your payment? You have a car payment. What does that look like? How much are you having to pay on a student loan? Do you have a credit card, and how much are you paying on that credit card? And when you think about how much you're paying on that credit card, are you just paying that minimum payment just to get that bill off of your desk? Are you really chomping down and getting into some of that principal? But looking at all of that and writing that down will show you exactly how much of that bring home income that's coming in every single month is actually immediately going out and servicing those debts. When we meet with people at Family Wealth Group, a lot of times they're surprised at just how much money, when we add it all up, is actually going out to service that debt. And so we need to know that so we can start building a plan to see if we can reduce some of that debt and some of those payments.
Jeff, another important number is our credit score, whether you're buying a home or applying for a car loan. Why is that so important? And what is the target number that we should be trying to get for our credit score?
You know, especially right now, Jennifer, it's been very important because over the last several years, especially the interest rate environment has really changed in our country. And for a lot of people, the opportunity to do a refinance on their home maybe kind of consolidate some of that debt and tie it all into a better loan with a lower interest rate and sometimes even a better payment has been a very valuable exercise for people because they're paying less interest and they've improved their cash flow. But at the same time, if you don't have a good credit score, then you may not qualify for that loan, or you may not qualify for the best interest rate for that loan, and it may mess up your overall plan. So making sure that you're staying on top of those payments and making sure you don't let a late credit card go by or miss a car payment or something like that is very important so that you can stay on top of those loans and get the very best deals that the mortgage companies and banks are offering right now.
A recent survey found nearly 30% of Americans stopped saving for retirement because of fallout from the pandemic. So what advice would you have to people about saving for retirement?
You really got to try to bootstrap this thing right now and get it back on target. There's this delicate balance between having to live life and take care of today and being able to, go on a vacation and do things for your children and grandchildren while at the same time planning for the future. And so that is a delicate balance, and we want to empower people to live. It's been a rough year, and to sit down with people and say, well, you just have to save and you have to sacrifice and you have to do all of this. we got to be careful with that, because we do need to live right now, and we do need to, get back to being with our family and taking trips and kind of relieving some of the stress over the last year or so. But at the same time, we do need to continue to plan for the future. So just making sure that, number one, what do your employer benefits look like? If you put in $1, are they putting in $1? You want to take advantage of that. If you put in $1 and they put 50 cents in, you want to take advantage of that. So just know where you are, and maybe you can't start saving for another 6 months, but have you really put a pencil to the paper to plan that out, to make sure that you're ready in maybe 3 months, 6 months? It may take a year before you can start getting back to saving, but we really need to also prepare for the future.